So I think overall, basically, the way I would describe the economy over the past year is that it's decelerating, but it's been hanging in there, and it's in large part because there's so much money in the system, and so it was looking more recession-like without actually being a recession. Um, this recent issue with the banks, actually, in some ways, both adds a catalyst in both directions. So on one hand, if this ends up being the ceiling for overall Fed tightening, roughly speaking, um, and a liquidity floods back into the market, that can actually be attractive for the economy. So, for example, if you look back at the repo spike of 2019, in that few months that it happened after that, in addition to getting rebounding in asset prices, you actually had a minor rebound in economic indicators because you had more liquidity kind of entering the market. You had the dollar come off. You had a number of things like that were good for not just financial assets but actually real economic indicators. Obviously, that got killed by the COVID crash, but for that kind of brief window, that's what was happening. So it's possible that you get like a brief window here where liquidity, kind of presents like a bottoming in liquidity, and you have a decent period of time. On the other hand, it's largely going to depend on bank behavior, right? So if banks really tighten up here, which it looks like they might, then they might be able to override that liquidity. And so the way I would describe it is that I think the general direction is towards recession. Um, I doubt it'll be as severe as some people are concerned with. I think it might be kind of like the post.com bubble recession, which was actually in many ways the mildest recession, of many recessions before or after it. But again, at large, it depends on human decisions. This is an actively managed system, and so it depends on what the humans at the helm do of it. I think there are a number of sectors that are resilient, things like healthcare, energy pipelines. I think that there are a number of spaces that are interesting. Whereas I think commercial real estate, I wouldn't really touch that. Unprofitable tech, I'd be highly selective with what I'm interested in touching there. But I think other parts of the economy are fairly resilient, and it just depends on how much we want to do policy mistakes to see if we can disrupt that resiliency. I think in the next 6 months, I'm honestly highly uncertain of the shape of the yield curve because there's so many human decisions that go into that. I think if more people, like if you look at break evens, the market does not expect long-term inflation, right? So if the market determines for one reason or another that long-term inflation is going to be a problem, then it very much might try to drive those long end yields higher. And then you could get some sort of situation like the UK ran into where they have to intervene in the long end of the curve to prevent a liquidity problem. And so but I don't know if the market's going to realize that in 6 months, right? They could be more focused, perhaps rightly, on recession risk for a 6 month period. So I think it really depends on path dependence, right? And I think that in this kind of stage right here, I think we have to be honest with what we know and what we don't know. And I think the next 6 months are really unclear in that regard. Whereas I think the longer term picture is what's more clear. It chopped around, much like the 70s. Basically, you had low valuations. I mean, obviously, you had a war going on, so people were not very bullish. It really kind of bottomed around when the United States started decisively winning over Japan. There were a handful of key naval battles that really, once those happened, it was basically a long grind towards a victory. And so the market kind of bottomed based on the war, right? So it's probably not a great signal for what to expect because it was moved around by that type of force. In general, if you have financial oppression, so you have super low yields compared to what inflation's doing, that should be pretty good for a lot of types of equities. But it depends if there's other factors big enough to hold that down. A lot of times, if you look at emerging markets, and in many ways, this is like an emerging market style recession where you have high inflation and currency problems, but economic contraction. A lot of times you look at those, the stock prices don't do bad nominally in the local currency. They just do bad in dollar terms and basically harder currency. So I think in general, the stock market is unlikely to do well in purchasing power. I think we're basically probably looking at a lost decade in inflation adjusted S&P 500, for example. Now, I do think that there's value sectors that could do well. There's certain emerging market sectors that could do well. But I think that the large mega cap, American stock market is probably not very well positioned for a 5 to 10 year period, especially when you price it either in CPI or gold or whatever you want to do for your pricing that's somewhat kind of a harder measure. Well, the narrow bank was proposed years ago. I believe it's a bank in Connecticut. But they essentially wanted a business model of taking deposit cash and putting it in the Fed. And there's been a number of other banks that try to do something similar. They're generally not allowed to do that. And essentially, if allowed to exist, it'd be among the safest banks you can have because it's essentially a full reserve bank where it's just kind of tied it right into the central bank. And that bank for depositors might be challenging in a low interest rate environment because they can't earn a yield. The bank can't earn a yield, and so they have to charge fees or some sort of way to stay in business for their customers. So it's essentially a bank for low risk depositors that don't want to take on any sort of default risk. On the other hand, if you have a higher rate environment where the central bank is actually paying out interest on reserves, then a type of bank like that can operate profitably and even pass on some interest rate to depositors, just lower than what they're getting from their central bank to cover their overhead. And so in general, there's, it's funny, basically banks are basically leveraged bond funds with payment services attached, and we treat it as totally normal to use this. It's like, where should grandma hold her money? In the highly leveraged bond fund. Like that's kind of how we treat it. And there's always been some people that want to do full reserve banking, and they've just generally not been allowed to operate because I think one of the risks there, from kind of a policymaker perspective, is if there's banks where all they do is give you direct access to essentially the central bank balance sheet, then why wouldn't a very large percentage of depositors want to go there, especially if it's a positive rate environment? They don't have to pay like a fee in order to have that exposure, and so you risk kind of sucking liquidity out from other banks into that vehicle. And so I think in some ways it shows how fragile the system is, that they don't really want some of these safer banks to exist. So yeah, I think there's two different answers depending on which direction we go, and I think it doesn't really work with the current system, which is really leverage focused. You basically have a constantly depreciating currency unit and constantly increasing amount of credit in the system. It doesn't really work. It doesn't really vibe well with that approach. Whereas if I zoom out, I do think we could have a healthier economic and financial environment if we weren't so leverage based, if not everything was based around fractional reserve banking. So I obviously, I would generally incline towards that type of model. But as a realist, I think, in this period of time, it's just not something that's generally allowed, but it's something I would like to see in the future. And, that's kind of what you see. I mean, obviously there's been people in the gold space advocating for that type of thing. More recently in the Bitcoin space, you have people that are anti-fractional reserve banking. They're more like, just hold your own money. And I think that's an interesting direction to look in, and something that I don't really buy into the economic view that currency has to depreciate and that we have to use constantly increasing leverage. I think that's an artifact of this kind of past century and a half. And I'm not really sure that the next century and a half is going to look like that. But that's getting cosmic. That's like zooming
Yeah.
out. Whereas in this kind of near term, I don't think a full reserve direct line to the central bank is something that they would probably be interested in allowing, because it does disrupt the Wells Fargos of the world. Well, nobody. I mean, basically, if you have if you have a bunch of either free banks or full reserve banks, you probably have some sort of underlying hard unit that requires energy to produce. Back in the day, it used to be gold, for example. Nobody could print gold. Miners could expend energy to get more gold. And that's how new money is created. I mean, you still have credit in those systems, right? So I mean, there's still short-term funding needs, liquidity needs, and there's still you can still kind of print claims on money, and so that comes down to individual lenders as well as the government can borrow money. So you still have some degree of money printing when you count all those IOUs, But in that type of world, nobody can change the size of the monetary base. That's what's somewhat different. Or at least they can't freely change the size of the monetary base.